I've talked to you about our positioning, our products, our partnerships, and our plans that together we believe will bring a step change in our operational performance. Let me now welcome CNH Industrial CFO Oddone Incisa on stage. We will jointly present how we expect actions and plans to turn to financial results. We've been using 2019 as our base throughout this presentation, given the exceptional nature of 2020 and the fact that we are only 9 months through this year in reporting terms. We are, of course, showing figures for fiscal 2020 and 9 months 2021 for completeness here. With the changes we are making, we are projecting that net revenues from our current industrial activities will grow with a compound annual growth rate of about 5%, which is above the industry average. This would translate to net revenues of about between 16.5 billion and 17.5 billion in 2026. This top-line growth, combined with the results coming through from our DRIVE program, will support funding of our continued transformation and expected to lift our profitability with the adjusted EBIT margin rising to between 5% and 6% by 2026, an increase of about 150 to 250 basis points from 2019. In terms of bottom line, we expect consolidated adjusted net profit, including financial services, to more than double over the period to between 0.6 billion and 0.8 billion by 2026. We are comfortable in shouldering these efforts and investments required ahead while growing our underlying gross margin levels across all our business units. Future collaborations and partnerships will be explored to synergistically improve this plan, yet these, as well as any potential upside coming from adjacent market opportunities as outlined today, are not included in this financial plan. Given the momentum from our product lineup and pipeline, we expect growth in our top line to outpace our markets. We are forecasting a compound annual growth rate of about 5% in our commercial and specialty vehicles and about 4% in powertrain. In our heavy-duty business, we have only just begun to see the result our new lineup can deliver. While the S-Way is well established with the refreshed and upgraded 2022 model just entering production, we recently launched the X-Way and T-Way sister families targeting the construction and chassis segments with partial or full-time all-wheel drive requirements. The medium-duty segment is expected to remain relatively stable, and in our strong light-duty business with its iconic Daily, we have experienced continued market momentum, which will certainly be propelled further through the plan by electric versions gaining ground. Through our partnership with Otokar in Turkey, we seek to complement our lineup in entry-level heavy buses, enabling us to further expand our reach to markets where we cannot as yet compete effectively on our own. The increasing share of zero-emission buses is driving our top line, as it is in trucks, due to the substantially higher net pricing for this technology. The long lead time order books in our specialty divisions imply steady top-line growth in line with both the economic recovery and public spending in the various fields of relevance to us. Our powertrain business unit will not only keep the strong engine supply business for CNH Industrial, but will also push ahead to win more and more customers in the areas of commercial vehicles, agriculture, construction, marine, and power generation. The global captive engines business segment is going to consolidate, and FPT Industrial is well positioned to take a lead as a reliable partner on both sides, providing engines and enabled for alternative gases and liquid fuels, while offering zero-emission powertrain solutions. Our plan assumes that most of the raw material component and transportation constraints we see today in our supply chain will level out over the course of 2022. While we continue growing volumes and gain and regain pricing power with our new products and enhanced services in the years to come. We have seen in Annalisa's presentation how we intend to streamline our operations and improve product quality with, for example, predictive maintenance on connected vehicles. We are committed to maintaining our SG&A at industry-leading levels, while we will increase our spending in R&D. Our DRIVE program builds on the operating plans in our business units and will deliver improved financial performance at operating gross margin levels over the next 5 years and beyond. The targeted adjusted EBIT contribution by 2024 amounts to about 500 million euros, with about the same amount coming through as additional run rate contribution by 2026. Reflecting increased levels of R&D and project-related OPEX, we expect to achieve an adjusted EBIT margin in our industrial activities of 4 to 5% by 2024, with a further step up to between 5 and 6% in 2026. This is an exciting and challenging time for Iveco Group, and my team and I are committed to delivering this plan. We have robustly tested the parameters and objectives we have set ourselves, and I'm confident we will hit our targets. Let's now look at the investment schedule embedded in our financial plan. We expect to invest in CapEx, including capitalized R&D under IFRS, more than 4 billion euros over the period of the plan, with annual investments almost doubling by the end of 2026, compared to 2019. Investment is another area where our partners have a critical role. By working with them, we are able to jointly fund projects that will reap rewards for both parties with co-owned intellectual property. This is a key element of our approach we want our partners and us to have, because skin in the game and the committed skills and investments are important and needed to achieve the best outcome. A great example is again our partnership with Nikola, which is reflected here in the new energy segment of our investments. This investment allocation might look significantly different for other OEMs. However, this is the result of how we partner and leverage our capabilities and resources effectively. Our investment plans are based on market projections, regulatory requirements, and our current pipeline of product launches. Depending on how the markets perform, particularly in the early part of the plan, our investments might flex up or down across the portfolio. I now hand over to Oddone to take you through cash flow, our financial services business, and financial policy.
Thank you, Gerrit. So let me go through the Iveco Group's free cash flow projections and selected balance sheet measures. Overall, we intend to generate positive free cash flow from 2022 through the end of the planned time frame, and will therefore expect to grow from a solid starting point the net industrial cash position to up to 2 billion euros by the end of 2026. Iveco Group will have separate and independent funding, with industrial activities third-party debt of between 500 million and 1 billion, growing from a June 2021 level of 200 million, as we build up cash for a safe start as an independent entity. We also intend to arrange a multi-year revolving credit facility with a syndication of primary global banks, and we will be reporting it in our available liquidity measures. As you have seen in the listing prospectus, the initial equity for the company is strong at 2.6 billion as of June 30, 2021. Finally, as said in the introductory remarks by our chair, none of the capital market debt held by CNH Industrial is going to be transferred to Iveco Group with a spin-off. On slide 45, we have our financial service operations. Iveco Group and CNH Industrial today jointly offer a full range of financial products specifically focused on their respective customer needs, including their large dealer networks and direct customers. In view of the spin-off, we have decided to maintain as far as possible common operation for Iveco Group and CNH Industrial, thus preserving obvious cost and process synergies. We have, though, been very clear in the need for separating the funding and the credit exposure for the respective portfolios, in particular in Europe, where Iveco Group has a larger presence. The current European operations of CNH Industrial Financial Services will be an integral part of Iveco Group and will service the receivables portfolio retained and then grown by CNH Industrial for their off-highway businesses. In other regions of the world, CNH Industrial will provide financial services to Iveco Group through long-term vendor agreements. Looking now specifically at Iveco Group, the receivables portfolio, including what is managed by our JVs with BNP Paribas Leasing Solutions and Santander Consumer Finance, is expected to grow to be between 6 and 7 billion by the end of 2024. While financial services net profit was affected by increased prudential provisions for credit losses in 2020, we expect it to rapidly return to historical levels and to continue contributing to the net profit of the group. Iveco Group will start trading independently with a solid capital structure. We believe that these and the plan that Gary and his team have put together will improve the liquidity in the balance sheet while investing in the future of the company. And management will maintain as a priority obtaining and preserving investment-grade ratings. While we'll talk about how we expect to invest into organic growth, with regards to inorganic growth, the Iveco Group intends to be both opportunistic and moderate in the approach to these investments, and no M&A transactions are included in the plan today. Shareholder remuneration is, of course, important, and the board will submit to the approval of the shareholders a dividend policy consistent with the net profit generation and the capital needs of the company. As we have noted previously, management incentives, quite rightly, will be aligned with shareholders' interest and tied to delivery of the plan, as well as the ESG ambitions. So back to you, Gary, now. Thank you.